What's going on, guys? Welcome back to another video here. So in this one, we're going to be going over exactly how the incoming housing market collapse, crash, correction is actually potentially a very good thing, especially if you are a specific type of individual. So again, guys, this is not clickbait. We're going to go over and break down this situation in its entirety. So if you do enjoy the information and analysis I provide for you guys in these videos here, if you don't mind going down, hit that like button on this video here. If you do want to see more videos like this, make sure you hit that subscribe button as well. So let's get right into it here and provide a little bit of a backdrop on the current situation that we are already in. So interest rates are important to the housing market for several reasons. They determine how much we will have to pay to borrow money to buy a property, and they influence the value of real estate. Low interest rates tend to increase demand for a property, driving up prices, while high interest rates generally do the opposite. The reason for this is that when you have low interest rates, your monthly payment is going to be lower, meaning that you can qualify for a higher priced home. Now, if more people can qualify for higher priced homes, it increases demand and it drives up the prices of real estate. Now, it happens in the exact opposite direction too. When rates go up, well, the monthly mortgage payment is going to be higher, meaning that you can no longer afford that higher priced home, and it takes demand out of the market, and that's exactly what we are starting to see. Now, when we come over here, mortgage demand from home buyers falls 29% since last year as interest rates surge past 6%. So when the Fed increases interest rates, mortgage rates go up, and we are starting to see this mortgage demand starting to slip pretty significantly. Now, when you think about the equity market, the stock market versus the real estate market is going to move a lot slower. With the stock market, well, you can just buy and sell stocks pretty willy-nilly whenever you want to in your brokerage account. With the real estate market, well, there's a lot more extra steps that need to take place, and there's a lot more time in order to complete a lot of these transactions, so it's going to move a lot slower. You have to file for a loan, apply, you have to go through the closing process, and then you actually have to go purchase the home and then finally move in. So it's going to take you a little bit longer, and the real estate market's going to move a little bit slower, but we are finally starting to see the effects of these rate hikes on the real estate market here. And again, the one area of growing concern, housing, due to a lot of the comments that Jerome Powell has been making, interest rate hikes can lead to higher mortgage rates, which can cause people to think twice about buying a home. Now, that's exactly what we are starting to see. People thinking twice about buying a home. That demand is leaving the market here, but it's presenting a very interesting opportunity because what are a lot of these people actually doing? Well, everybody needs housing. So instead of purchasing a home, well, they're just going to continue to rent. So if you continue to see people in the rental market heating up, the rental market continue to heat up, you see something exactly like this. Well, we've seen rents significantly increasing since 2020, but as the Fed started to increase interest rates here, and we got the notice that we were going to see the Fed increasing rates, well, we ended up seeing a lot of these essentially rental rates across the United States significantly increase. So the rental market right now is relatively hot. If you go and kind of do your own analysis on the rental market at places in your area, I bet you could find a lot of these prices of places to rent, whether it's a home or apartment, have significantly increased over the last 6, 8 to 12 months. Now, the other thing that we need to keep a lookout for is that the value of homes are going to continue to come down. The Fed is not done raising interest rates, and home prices are going to fall slower than what is going to happen in the equity market. When we come over here and take a look at the Fed Watch tool, which is essentially going to tell us what the probability is for these rate hikes coming up next week, well, we have about a 76% chance of a 75 basis point rate hike and a 24% chance of a 100 basis point rate hike. So we know we're getting more rate hikes. The Fed is basically set up what they would call their terminal rate right now, but it can always be moved if the data suggests that they're receiving from unemployment, any other inflation data that we are seeing too, that the terminal rate of where they want to take the federal funds rate needs to be higher. Now, if that continues to increase like we've seen, well, more rate hikes, higher mortgage rates, lower home prices. But I want to tie this all in together for you guys because I don't know if you've seen the big picture yet. If you have, good for you, but let's kind of wrap it in together for you guys that may have not completely gotten it. So, if you have declining home prices and you have the ability to qualify for these loans, or maybe even the cash to go out and buy some of these properties here, all cash, no mortgage. Well, you also see the rental market heating up still. It hasn't really shown any signs of slowing down. And if the Fed continues to increase interest rates, which they are most likely going to do, more people are going to go into the rental market. According to those basic concepts of supply and demand, rents should continue to maintain their elevated levels. Now, if you know, let's say you are getting a mortgage here, that your mortgage is going to be locked in at, let's just say $1,500 a month, but then you know that you can rent out the property for a significant amount more and you're able to generate cash flow every single month, well, then that's a very good deal. Real estate, again, is a slower game, and it can take a lot longer for these properties to appreciate in value. I know a lot of people might have gotten spoiled in 2020 and 2021 with that real estate boom, but now it's time for things to kind of come back to normal here. But this is an opportunity that I don't think a lot of people see. You have increasing rents, decreasing home prices. If you're able to get these loans and the deal works, it makes a lot of sense. So at the end of the day, the other thing you need to think about here too is this rule right here. The mortgage interest deduction is a tax incentive for homeowners. This itemized deduction allows homeowners to count interest they pay on a loan related to a building, purchasing, or improving their primary home against their taxable income, lowering the amount of taxes they owe. So even if there's higher interest rates and you can still get your hands on that property and it cash flows, well, you just got a better tax write-off. So at the end of the day here, when you think of it as an investment perspective, it's a lot different than if you were trying to personally live in these residences. From an investment perspective, if the deal works, it cash flows, and it makes a lot of sense. If you're thinking about buying a primary residence, though, it might not be the best time, as home prices are most likely going to continue lower, and the mortgage rates are actually going to be relatively high. So guys, that is going to kind of wrap up this video here. If you did enjoy the information and analysis that I provided for you guys here, make sure you go down and hit that like button. It costs you nothing to do it, but it really helps us out a whole lot in getting this information out to as many people who want to learn. Other than that, guys, I'll see you guys in the next one. Peace.